CoreWeave is trading at a 40% premium post-IPO, yet the latest SEC Form 4 filings show institutional insiders just offloaded 2.4 million shares immediately following the lockup expiration. The broader market is valuation pricing this entity as a pure-play cloud computing powerhouse, but the underlying balance sheet details a highly leveraged structural paradox that long-term capital allocators are completely misinterpreting. If we examine CoreWeave's first post-IPO 10Q filing, the structural risks become mathematically clear. This analysis is for educational tracking and capital allocation modeling, designed to isolate the downside risk for retirement portfolios. By the end of this breakdown, you will possess an objective, 5-point fundamental checklist to evaluate whether this asset protects capital or represents an institutional liquidity trap. To understand the core catalyst, we must look directly at CoreWeave's capital procurement model. Traditional hyperscalers like Microsoft, Amazon AWS, and Alphabet fund their data center footprint through retained earnings and traditional corporate debt. CoreWeave operates on a fundamentally different framework: asset-backed loans secured by their graphics processing units. According to page 32 of their recent financial statement, CoreWeave carries $7.5 billion in non-recourse credit facilities. The primary collateral backing this debt is their fleet of Nvidia hardware, including the H100 and H200 architectures. This introduces a severe structural anomaly: hardware backlog conversion rates. The market prices this business on the assumption that an internal backlog automatically converts to predictable long-term subscription revenue. However, the audited numbers reveal a widening gap. In the last quarter, CoreWeave's hardware delivery pipeline slowed down by 14 weeks due to localized data center power constraints. When infrastructure delivery stalls, the cash generation cycle is delayed, but the interest obligations on those asset-backed loans remain fixed. Furthermore, customer concentration risk is exceptionally high. The 10Q notes that exactly 3 artificial intelligence startups generate 72% of CoreWeave's current cloud services revenue. This is not diversified enterprise-grade revenue. This is a highly concentrated counterparty risk profile. If just one of these early-stage artificial intelligence startups fails to secure its next venture capital round, CoreWeave's recurring revenue contracted run rate collapses by more than 20% instantly. Let us filter the noise by looking at the current valuation multipliers. CoreWeave is currently trading at a trailing enterprise value to sales ratio of 28 times and a forward PE multiple exceeding 64 times. To contextualize how extreme this is, we must run a direct comparative analysis against established infrastructure operators. On a forward enterprise value to sales basis, COWR sits at 28.2 times, compared to Azure at 11.4 times and Amazon AWS at 8.5 times. The sector average is a mere 4.2. When we look at structural gross margins, CoreWeave is severely compressed at 34.2%. Compare that to Azure at 68.5% and AWS at 61.2%. The sector average is 44.8%. This leads to an operating margin of just 11.4%, while Azure hits 42.1% and AWS reaches 38.4%. The numbers tell a completely different story than the prevailing retail narrative. While CoreWeave's top-line revenue expansion looks impressive on a year-over-year basis, its structural gross margin is severely compressed. Traditional hyperscalers maintain gross margins above 60% because they own the physical real estate, the proprietary hypervisors, and the global fiber networks. CoreWeave, by contrast, operates on a heavy leasing and co-location framework. They do not own the underlying power infrastructure, they lease space inside third-party data centers. This structurally limits their long-term operating margin capacity to 11.4%. When you factor in their annual capital expenditure required to maintain pace with Nvidia's rapid product lifecycle, CoreWeave's free cash flow yield drops into negative territory at -8.4%. Traditional players like Azure and AWS generate positive yields around 5%. For an investor focused on capital preservation, paying 28 times sales for a negative free cash flow asset represents an asymmetric downside risk. The hidden trap in CoreWeave's business model lies in the technical obsolescence rate of its core assets. Because their debt is tied directly to the valuation of their GPU hardware, any drop in the market rental rate of an H100 chip triggers a severe margin compression risk. Nvidia's rapid deployment of its new Blackwell architecture creates an immediate problem. As larger cloud providers transition to Blackwell, the rental pricing power for older H100 and H200 silicon historically declines by an estimated 30 to 40% annually. If rental rates drop, the underlying valuation of the collateral backing CoreWeave's $7.5 billion debt facility drops with it. This could force the company into a technical covenant breach, requiring them to either deposit more cash to satisfy lenders or liquidate hardware into a declining market. We saw this exact same margin collapse play out in our recent deep dive on Cerebras systems. If you haven't watched that fundamental analysis yet, I will link it at the very end of this video, because the underlying structural pattern is completely identical. Just like Cerebras, CoreWeave is buying temporary market share by using extreme leverage while masking massive customer concentration risks behind an AI growth narrative. For mature capital allocators, ignoring this hardware depreciation cycle is the fastest way to experience permanent capital impairment. Let us synthesize this into our emotionless investor checklist mapped directly to retirement portfolio safety. Metric number 1, structural margin protection, failed. The 34.2% gross margin is insufficient to absorb hardware depreciation. Metric number 2, counterparty risk control, failed. 72% revenue concentration among 3 speculative AI startups is highly volatile. Metric number 3, balance sheet autonomy, failed. The dependency on asset-backed debt facilities exposes the company to severe liquidity shocks if chip pricing falls. Metric number 4, free cash flow durability, failed. Free cash flow yield remains negative due to intensive CapEx reinvestment needs. Metric number 5, valuation margin of safety, failed. A forward PE of 64 times leaves zero room for execution delays. The verdict for CoreWeave is a strict avoid at current price levels. The underlying asset is built on a foundation of structural leverage and concentrated customer risk that fails every metric of conservative asset allocation. To see exactly how the structural leverage compares to the hidden risks and customer concentration traps we uncovered in Cerebras systems, click the video on your screen right now.